Advanced Financial Accounting OneNote Practice Problem. In this presentation, we will work a practice problem in OneNote related to a consolidation where we have a parent-subsidiary relationship. There's less than 100% owned, but a controlling interest. In other words, somewhere between 50 and 100% owned by the parent. Therefore, there's also going to be a non-controlling interest. There's going to be a fair value that's going to differ from the book value we will be dealing with. There's also going to be goodwill involved. We're going to be doing the consolidation for year 2. In other words, basically the consolidation or the purchase took place 2 years ago, and then it's going to be the second year, 2 years exactly have passed, in which we're going to actually do the consolidation as of that point after 2 years have passed. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. We're going to go over the information related to the problem first. Then as we go through the problem, we will be pulling pieces from this to work the problem. We have P purchased a percentage of S on January 1st, 2000 X 0. So the actual purchase took place on January 1st, 2000 X 0. P is going to be the parent. S will be the subsidiary. The interest purchased 75%. Therefore, the controlling interest 75, non-controlling 25. Amount that was paid $108,000. The fair value of the non-controlling interest is $36,000. Book value of S net assets, meaning assets minus liabilities, or the book value of the organization of S, the subsidiary, as of the point of consolidation, $100,000. Book value and fair value differences. In other words, if we took all of S's, the subsidiary's assets and minus liabilities, and looked at the individual accounts, the individual items, we're going to say that they're all the same, book and fair value, except for fair value of building and equipment, which had $20,000 higher than the book value. So that means that we're not going to record anything for the subsidiary with regards to that, because the subsidiary is going to keep on rolling along. But as we do the consolidation, we're going to increase the equipment and the depreciable assets by that $20,000. That also will result in differences to accumulated depreciation and depreciation expense we will have to deal with. Accumulated depreciation at the point of purchase, $30,000. Then we're going to use a straight line method using 10 years to depreciate that $20,000 increase in the fair market value. The goodwill carrying amount is $2,500. That's as of the end of 2000 X 0. So remember that 2000X, we're going to be doing the consolidation as of 2000X1, in essence, 2 years after the purchase. So it was purchased January X0, so we got the end of that through December of X0, and then we're going to be doing this at the end of X2, so that's going to be the 2-year time period. Now, we're going to calculate the goodwill then at the point in time the purchase took place. Then we're going to recognize that the carrying amount was different, meaning there was a decline in the goodwill that we calculated, but that happened last year, or it happened a year after the purchase, but prior to the current year that we're currently consolidating. Therefore, there's not going to be any effect in the current year net income with it. So we have to take that into consideration when we do our consolidation. Okay, so let's get down to the calculation of the goodwill. Let's go over the calculation of goodwill. So we've added our little kind of reveal strip here to make it a little bit more exciting. So we're going to say the book value of S is going to be the $100,000. We're going to get that from our data, the book value of S being here. That's going to be the assets minus liabilities, or the equity section, as of the point in time of the purchase. Then we're going to say the fair value over the book value for certain assets, those being the accumulated depreciable assets here. The fair value was higher by $20,000. So if we took the original book value of the entire company, in essence, equity section as of the point in time of purchase, assets minus liabilities, plus the fair value of the assets that are greater than the book value, then we have the fair value of the organization, we're saying, at the 120. Therefore, if 100% of the organization was purchased, you would think the payment would be 120 unless there was goodwill involved. Then we're going to say that the fair value of the non-controlling interest, which if they didn't give us a number for it, we would think would be, the 25%, but they did give us a number. That's going to be $36,000. So that means the 120 minus the 36 is the $84,000, the amount which you would think would go to the controlling interest if there was no goodwill involved. There was goodwill involved because we paid $108,000. So the amount paid is $108,000. Therefore, the goodwill is the 108 minus the 84, or the 24,000. So we're going to put the goodwill on the books for the 24,000, but then we note that it was impaired at the end of the day, or the end of last year, and the year before we're consolidating, but the year after the purchase took place, so we'll have to deal with that in the future. Now let's go to the equity method. We're going to be considering the equity method calculation. We'll bring over our little review thing here. So we're going to say then that we have, these are P's books, these are S's books, parents, subsidiary. This is as of the point in time that we're consolidating 2 years after the purchase date. Now, P is recording their investment in S using the equity method. And that means that this account here is representing their investment in S on the balance sheet side of things, and this account represents their investment in S with regards to their portion of income that S has then earned. So we want to reconstruct this account. Now, we can't really reconstruct this one fully up top, the balance sheet account, because that is a permanent account. So it's year 2, so we'll just look at what happened in the current year. We should be able to reconstruct this account, the 31.5, to see how that came about, and then that'll help us with the consolidation entries or the elimination entries. So let's do this. We're going to say, all right, first off, we typically say, all right, let's do the normal items. We're not going to record the purchase here because that happened last year. We're just going to record the current year information. Normal equity method stuff would say, hey, let's take the net income. That's revenue minus expenses. And I'm going to take that 44,000 times 0.75 controlling interest. Our portion then of that would typically be the 33,300. That's going to increase the investment and increase the investment with a debit to the investment, credit to the income. So that would be going to these two accounts. Now note here, this doesn't tie out to the amount down here in the income account like you would think it might, because remember that S is not taking into consider some of the activities such as the depreciation that we're going to have to deal with when we do the consolidation. So we're basically doing the equity method, knowing what we know about the added information with regards to the consolidating entries. Next thing we would typically do, so we'll deal with that later. Next thing we will do is we'll typically say, hey, the dividends. S gave dividends of 26,000. Some of those went to P, the parent. So subsidiary to parent, 26,000 dividends, 75% went to the parent. That means the dividends on the parent side, 19.5. Then we're going to be crediting the investment for, that 19.5 as well. Normal equity method type stuff there. Then let's actually move this thing out of the way completely. Then we're going to have the not so normal kind of equity thing that we will have to deal with. And this is going to be related to the depreciation that we had down below. So that's why we've got this information down below related to the depreciation. So we have the book value of the equipment now being higher by 20,000. That's a balance sheet item, so we're not going to include it in our equity calculation here, but there will be an income statement factor, that being the depreciation related to that added book value, which we're going to calculate as 20,000 added depreciable asset divided by 10 years, straight line method, and then we're going to multiply that times 0.75, the controlling interest. That's going to be debiting the income from S, basically reducing the amount of this credit balance representing our income, because it's kind of like an expense that's being included in there, and then decreasing the asset account. So that's what we're going to have. That's going to be the recalculation of these numbers. Now, if we see all of them together, then we're going to say, let's add them up and see what happens. The green ones are going to be the investment accounts. This 12,000 does not match the 12,000 that we have here. We don't have 12,000 there, in other words, because this represents everything that happened since the point in time that the purchase took place. That was 2 years ago, and we're only calculating here for the current year. But this number, the 31,005, does match what we have over here. That makes sense. So once we do the elimination entries, we know that these two accounts, this one and this one up top, need to go to 0. This, if we reconstruct the equity method, will help us to deconstruct these if we have any problems, because we can see how they were basically put together. All right, so then let's go on down and let's start doing our transactions down below. So here is our journal entry. So I'm going to start off with the investment account, even though I don't want to calculate the number. I just want to post the investment account at this point, and we'll get back to that. Then we're going to remove the equity accounts. This is standard practice, right? So we've got the credit over here to the equity account for S. We're going to remove it, in essence, therefore debiting it. Then we got the retained earnings, 48,000. We're going to debit it for the 48,000. Then the dividends is a debit of the 26,000, which we will then credit to remove it. So if we post them out, the posting is going to be over here in the consolidation column. We're going to always be having the consolidation column, which will be posting this out as we go. So it'll include all the transactions, including the current one we are on, up to the current one we are on. So what we have thus far, we've got P's books, we have S's books. First thing we do, total them up. This is going to be the total then of P and S. Then we think about our consolidation and or elimination entries. This being our first consolidation and or elimination entry, it being posted in this column. If we consider these items down here with equity, standard practice, this is P's equity, this is S's equity, this is the total then. Then in essence, we removed the portion that was S's, which basically brings us back to P. So now we're basically back where we started at P's information. Then we have the income from S. So income from S down below, what we're going to be taking there is not reversing. We're not going to be reversing the entire amount right now of the 31.5. What we do instead is just calculate kind of like the equity method for now, and then we will get this down to 0, but not at this point in time. So for this journal entry, we're going to say 44,000 times 0.75. That's going to be the 33,000. Now, again, you could do this differently and group these journal entries a little bit differently, but we're going to try to start standardizing this because as we get into more complex problems, we'll try to make this a standardized kind of format. Although, of course, again, you can think about this in multiple different ways. But we're going to say there's the 33. If I record that, then now we're at a debit of the 1,500, which looks like that depreciation, which is the thing that's not being accounted for here. So we'll talk about that later. And then we have the non-controlling interest in net income. So that means we're going to be taking this 44,000 times the non-controlling interest, 25% of it, and that's going to be the 11,000. So there is the 11,000, and then we have the non-controlling interest in NA, and so I'm now looking at this account and this account. So now we're considering this account and this account. So to do that, we're thinking about the balance sheet side of things. So I can think about assets minus the liabilities, which will be the same as all of the equity accounts. So of course, those we can calculate it either way. And those are going to match the middle portion here. So I can calculate it either way. I can say, all right, let's go ahead and add this up. That'll be fun. 34000 plus 18000 plus 28000 plus 29000 plus 167000 minus 36,000 minus 14,000 minus 5,000 minus 95,000. That comes out to the 126,000. I should be able to get to the same number by doing these blue accounts down here. So let's see if that's the case. 60,000, unless I made a mistake. 48,000 minus 26,000. That almost never happens though. And then plus, and then we're going to be taking all these accounts, but I'm just going to take the net income down below. That happens all the time, in case anybody. We're going to say that's the 126. Okay, and then these accounts in the middle should be 126 as well. Right, so I'm going to say, all right, then 60,000 plus 48,000 plus 33,000 plus 11,000 minus 26,000. So there's the 126. So now we can take that and break it out between the two kind of balance sheet side of the accounts. Controlling interest going to the investment account, non-controlling interest going to the non-controlling interest in net assets. Not the income statement accounts, which are these two, but the balance sheet side of things. So we're going to say, all right, take that times 0.75. There's the 994.5. And then, of course, if I took 25% of it, we would have the other side. Where did my mouse go? I forgot what the amount was. So 60,000 plus 48,000 plus 33,000 plus 11,000 minus 26,000 times 0.25. There's the 31.5. So if we were to post this out then, let's go ahead and see what that'll look like. See if I can delete some of these tags. Okay, so then we're gonna post this out. So if we post this out, then the investment account is up here. So we've got the investment account is included here. We already looked at the common stock. The income from S is here. So we're at that debit balance, not down to 0 yet. Non-controlling interest recorded down here. And then the non-controlling interest recorded here. This is our ending number thus far. Next transaction. So we have this one up top is the one we just did. It's still included over here. So it's now included in here. And now this is included as well. Okay, so we have the reveal box here. So we have a bit of mystery as we go through this. We're going to now be including the building and the machinery. So this is going to be the item that we said the building and the machinery had increased by the 20,000. So it was 20,000 higher for the building and machinery. So we're going to include that now. So we're going to include that. And then we also said that the goodwill was 24,000 higher. Now this came from the data in the problem. This goodwill, I'll scroll down a little bit. We had in this calculation when we did this goodwill calculation, you can see it up above as well, but that's going to be this 24,000 goodwill calculation. These are going to be the balance sheet side of things. Now, when we put these on the books, we're going to say, hey, look, there's going to be an income statement effect here because of the depreciation, and if there's any impairment to the goodwill, then we'll have to deal with that. Could affect the income statement as well. But right now, we're dealing with the balance sheet side of things. Then we're going to be breaking this out between the two balance sheet kind of components, between the controlling, non-controlling interest, that being controlling interest in investment in S, non-controlling interest in the net assets. So I'm going to pull up the trusty calculator here. We're going to say the 20,000 plus the 24,000 times the controlling interest 0.75 interest. There's the 33,000. If we take the 20,000 plus the 24,000 times the 0.25, the non-controlling, there's the 11. So that's going to be affecting then the machinery. So that's going to be here. The goodwill is going here. Then the investment in S is going to be here. It's included in this number, not yet to 0. So we still have work to do there. And the non-controlling interest in A is going to be going here. Okay, next item we have, scrolling on down, is we're going to say that we have the Goodwill Impairment. So now I'm going to put the Goodwill Impairment on the books. Now notice, in practice, we would probably start to net these out because this is a little bit different than the prior problem, and we want to note when the impairment happened. So we're going to say, okay, we put the goodwill on the books up top. We put the goodwill on the books at the 24,000. That basically happens at the point in time that the consolidation took place because that's when the goodwill was created. Then we're going to say, okay, it's possible that the goodwill gets impaired, means it goes down, not because of depreciation or amortizing it, but we test it each year. And if we test it and it's down, then we've got to write it down at that point in time. So if that happened in the current year and we had to write it down, then we would reduce the goodwill and we would record the other side to an income statement account, basically a loss account. But this happened last year, so we could have included it, like netted it together, put the goodwill up here at the net amount, which would be a little bit faster, but we want to break it out and recognize it and say, okay, now we're going to decrease the goodwill, but it's not something that happened in the current year. So if it happened in the current year, we would decrease goodwill, the other side would be going to this loss account over here. But obviously that then rolled into kind of like the equity section, so it's just a balance sheet transaction that happened here. So this is what's different than the prior one. I'm going to decrease the goodwill here, but the other side is going to just go to the balance sheet accounts because, again, this is something that happened in the prior year that we're still going to have to, deal with every year we do with a consolidation. We can combine this entry and the prior entry together going forward to make the future consolidations a little bit more condensed. So we're just going to say, all right, well, the goodwill's got to go down to the carrying amount, which is this 2,500. So the 24,000 that's on the books right now minus the 2,500, it's going to give us that 21,500. It's got to go down by. Notice I'm putting the credit on top because I'm doing this as I think about it, not just like debits and credits on. And then I'm going to allocate that between the two balance sheet accounts, not the two income statement accounts, for controlling, non-controlling interest, investment in S, controlling, non-controlling interest in A, the non-controlling. So I'm going to take that 21,500 times the 0.75, that's going to be that 16,125. Then I'm going to take the 21,500 times the 0.25, and that's going to be that 5,375. So there we have those. Breaking those out, that means the goodwill is now down to that 2,500, the carrying amount. The investment is here, so the investment is going to be included in this account, not yet at 0, but getting there. Non-controlling interest is going to be here, so it's going to be included in this number. So that's what we have thus far. Now, scrolling down, this is everything that we have done so far. It is included in this column, and now we're going to be going to the new thing that we're going to be calculating, and that's going to be this basically the depreciation portion item. Now, I'm going to kind of break this out in a way that I think it makes sense to me. So again, you can kind of group this in a couple different ways. Notice that we had this 20,000 increase that we have recorded into the building and the equipment. We're going to have depreciation related to that as well. Now, we're going to have depreciation for every year after the consolidation takes place that we're going to have to calculate. So that means this year's year 2. That means last year we had some depreciation related to this as well. So that means that the accumulated depreciation needs to go up for basically last year's depreciation. So in other words, the depreciation per year we had another 20,000 divided by 10. It's going to be $2,000 per year. Last year, we had the other $2,000, which would be increasing depreciation expense, but it rolled over into retained earnings, and then it would increase the accumulated depreciation. So I'm going to increase the accumulated depreciation, the balance sheet side for last year's depreciation, and then break that out between the balance sheet accounts for the controlling and non-controlling interest, the investment in S and the non-controlling interest in NA. So that 2,000 times 0.75, that's going to be in the investment account, and that 2,000 times 0.25, that's going to be going to the non-controlling interest. So that's going to be here. We've got the depreciation. It's going to be included in there. This includes everything thus far, including this next entry we'll be taking a look at. And then the investment account is going to be this account up top. So it's included in here, not quite to zero yet. And then the non-controlling interest. So notice these are equal and opposite. So that's kind of a good sign. We're getting close. We don't want to just remove them. We want to kind of think about why. So we'll get to that soon. And then I'm going to record the current year depreciation. So I'm going to record the current year depreciation, which is simply going to be our normal depreciation entry. I'm going to do it this way. Again, a couple ways you could think about it. And then I'm going to think about the fact that now we have an adjustment to basically the net income, which means we're going to have an effect that we're going to have to break out between the non-controlling and controlling interest regarding this expense that affected the net income in essence. So this would be the depreciation for the current year, which is going to be $2,000, increasing the depreciation expense for the $2,000 and crediting the accumulated depreciation. So that's why we have the $4,000 up top. All right, next item. So this is what we've done thus far. So all this stuff is included in this column over here. This is the current one that we're going to be working in on here. So now we're going to say, all right, this last one we did, this depreciation affected the net income. So now we need to be breaking that out between, the controlling and non-controlling interest side of it as well, to reflect the fact that using the equity method, we had accounted for that in our equity method calculation of basically this number. So we're going to take that 2,000. So we'll take the 2,000 times 0.75. Controlling interest means that we're going to credit the income from S account by the 1,500, and we're going to debit the investment account by that 1,500. And there's a couple ways you can kind of think of which way is this thing going. Notice that if you go back up to the equity method calculations, you'll be able to kind of deconstruct this and say, well, what's included in that 31,500? We did an adjustment for this, and this was basically at that point debited for this amount, right? Because it was decreasing this amount, reflecting the basically net income. So to get this back to zero, we would have to credit this for that amount to kind of reverse it, to deconstruct it. And then you could mull over similar logic for the investment account. And also, of course, that's what was left in the investment account up top, right? That's what we had up here. So that means that's what we needed in order for it to go to zero. So that's why it's there as well. Then we're going to say, all right, then we have the 2,000 times the non-controlling portion, 0.25, and that's the 500. So similar logic down here, you're going to say, okay, this non-controlling interest represents basically the net income in a debit format here, and now we're talking about this depreciation. So we would need to basically credit it. We need to basically make that number go down to reflect it, and then the other side's going to be going to the non-controlling interest up top, non-controlling interest up here. Okay, scrolling back down, moving the calculator out of the way. This is what we have thus far reflected in this column to the right. Then we have this information for the accumulated depreciation. So we are in year 2 now, so they're going to have to give us what the accumulated depreciation. This is what we've seen in the past, so all we're saying is that at the point in time of purchase 2 years ago, 2000x0, this accumulated depreciation was 30,000. So we need to net out that accumulated depreciation with the book value as if basically a purchase took place at that point in time for our consolidation. So we're just going to net that out with a debit to the accumulated depreciation, decreasing it, credit to building and machinery, decreasing it. So building and machinery then being affected and the accumulated depreciation being affected, those then both going down. All right, and then scrolling back down. Well, let me just a second here. Now we're going to take these ending numbers, and you can see now we're basically, these are zeroed out. You can see that these accounts reflect these accounts over here for the equity section. In other words, the equity section basically represents P's books. Now we're going to take this information and make financial statements from it. Now, when you look at the financial statements, we're really just kind of putting this together and concentrating on this non-controlling interest. How is this non-controlling interest being reported? Because if P and S were fully owned, 100% owned, it would make perfect sense to just combine this together, and then this combined financial statement would basically reflect the combined financial. But if you got this non-controlling interest, that's where the focus is. If you got this non-controlling interest, how are we going to deal with that? So on the consolidated balance sheet, note we got the assets here up top, and all we're doing is recording all the assets. Notice all the assets are on the books as of full assets. They're not like, it's not like we're taking, because notice the consolidated financial statements are usually there for the people who are investing in some way or are interested in P, the parent company, like if you're a stockholder in the parent company. So then you might think, well, if that's the case, then why wouldn't I just record the 75% interest in cash and in accounts receivable in each line item? And that would be reasonable, but that's not what we do. And the part of the reason for that is because even though, like, if you were to liquidate, 25% would go to the non-P people, non-P shareholders, right? It would go to not P company, but to others. P has a controlling interest and therefore has ultimate say over what to do with those assets as they're in business, assets and liabilities. So that's kind of a justification to say, hey, I want to see the total things, all assets and liabilities that P has control to manage, and see how well they manage, and then see the net effect, what would basically go to the non-controlling interest basically at the point of liquidation. So that means assets, liabilities, all the same as if one company, right? They're combined together, 100% total assets. Liabilities, again, totally combined together here. There's the total liabilities. Then the stockholders' equity down here, this is where the difference happens. We've got the controlling interest, that's the 186 and the 183,375. So then we're breaking out the total controlling interest at the 369,375. Then we're going to say, hey, look, there's this non-controlling interest portion of the 36,125 to get to the total stockholders' equity. So down here is where we're going to say, on one line item, just say, hey, look, this is the component of the net assets, assets minus liabilities, the net book value, or of the third, that's going to be, if you could think of it like if liquidated, would not be going to P, the parent company, controlling interest. It would be going to the non-controlling interest, even though having a controlling interest by P means that P is able to basically manage the use of the assets up top, and therefore we can now look at the income statement, which would be considering the performance of how well they were able to manage those assets, those net assets. So we've got sales, total sales, again, 100% of S and P. And then we've got the expenses down below. I just grouped them all together here. So that's the total expenses. Notice what's not included in the expenses, that is that non-controlling interest account. In other words, if I scroll back up, this account is basically acting like an expense to get to this bottom line number here, the non-controlling interest account. But we're going to make a subtotal. So it's going to do the same thing here, but we're just going to subtotal it. We're going to say, hey, this is the consolidated net income here, and then we're going to put in this non-controlling interest, which was acting kind of like an expense on the trial balance, and that'll basically bring us down to the income to the controlling interest, which is the 91.5. Then if we look at the consolidated retained earnings, we got the retained earnings at the beginning, the 127,875, which of course is just like it normally would be, this number 127,875. And then we got the 91.5 here, subtotal, and then we're going to reduce the dividends, the 36,000, to get to the 183,375. Of course, that 183,375 should be on the balance sheet as well. So if I go on up to the balance sheet, we're going to say that the retained earnings right here, 183,385. We can see, of course, that we're in balance with regards to the balance sheet here and here, and then the net income number, the 91.5, is included in the consolidated retained earnings statement, the 91.5.